Are you retired and maybe you feel like I'm still paying too much in taxes? I'm taking out money for my investments. I have a pension. Now I'm taking Social Security and I'm having to pay more taxes now than I had to when I was working. And so we see that happen a lot. And if that's you, then you're going to love today's video because we're going to be talking through some strategies of how to fix this, how to make sure you can plan appropriately. And maybe you're not in this situation yet, but soon to be. Well, then maybe there's some things that you can start doing sooner to start preparing for this.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Let me first start off by saying that if you have to pay more taxes in retirement, is that a good or bad thing? I know it's a trick question. It's technically both. But it's technically a good thing because that means you have done a great job. You have a pension, which very few have, less than 20% of people. You have been a diligent saver with IRA withdrawals or investment withdrawals on top of that, which are going to force you into the same or higher tax brackets than you were when you were working. And so we want to applaud you for that first and foremost. This is a good problem to have. I know it may not always seem that way, but you do want to maximize it. You do want to be the best steward of what you save so much for. And so that's what we're going to talk about on today's video. And we're going to talk about a huge pain point that people with pensions have, and that is taxes, right? Having to pay more than the majority of their peers in retirement. The other thing to think about this when it comes to taxes and pensions specifically is the older you get, typically the worse it gets. And you're probably wondering, why is that the case? And there's a few reasons why, right? Let's just start from, the age of 60. Let's say that you retire at 60. Well, maybe you have your pension, or maybe you're delaying your pension until 65 or however that works for you. And then maybe you decide, I'm going to delay my Social Security as well. So maybe when you start out, your taxes may not be that significant because you're early on retirement. You also haven't had to worry about Medicare premiums starting, which starts at age 63 is when that gets calculated. And then when you're 65, they look at what your income was at 63 to determine how much you pay. And so you may not understand this is a big problem early on in retirement, or maybe you're just getting ready to retire and all you have right now is your income. You haven't started Social Security, you haven't started that 63 for Medicare, and you're thinking, man, this isn't going to be too bad. And we see that happen a lot to people, that they don't realize that they're going to be in the same tax bracket or higher with their pension. And they may not be thinking that, right now is a relatively low tax rate environment, and some suggest that tax rates could go up higher in the future. And so all these could lead for you to pay more in taxes gradually over time. But one of the biggest things that can cause you to pay more in taxes is what's called required minimum distributions. Some call them RMDs. And so this is what a lot of people are worried about. And it's going to be called a retirement tax time bomb because it's just going to happen to you when you reach 73 or 75, where you're required now, you're forced by the government to take out money from your tax deferred investments, your IRAs, your 401ks, 403b, TSP, all of those investments you've been saving for so long. And so again, you may say, hey, I'm only 60, I don't have to worry about that. For now, you don't, but now may be the time to start planning for those future RMDs, knowing how significantly those can be. Maybe you have $2 million at 60. Well, your investments could double by the time you reach 75. And if that's the case, you would have to take out $4 million, or you'd have $4 million to withdraw your RMD from, which, about 4%. You're going to have to take out about $160,000 on top of your pension, on top of your Social Security. That's probably going to force you in a much higher tax bracket throughout your retirement. So those are things that we want to start planning for now. And if, most people watching these videos are 50s and 60s. And so you've probably not seen the RMD, maybe you've heard of it, but you haven't been thinking about it in depth. And so we always recommend to people, make sure you're factoring in your planning of an RMD to make sure you can get ahead of that. Because as we just went through, this RMD can not only force you to be in higher tax brackets, but now you could be potentially paying double or triple or quadruple your Medicare amount, because Medicare is based on your income. And it's not, you don't get better coverage the more you pay for it, but it's means based. And so those who don't have as much saved are not going to have to pay as much for you. So the good thing for you is you can plan appropriately. Maybe we look to do some Roth conversions or paying taxes now so that we can be in a lower tax bracket situation when we take those RMBs, because we don't have to take as much. But those are all things that people who are retired want to start planning for, or make sure they've got a plan for. And that's really the name of the game, is how do we be tax efficient? And a lot of people think of this from an income planning standpoint. One way is to lower the RMDs that we talked about. The other thing to decide is, when should we take Social Security. That's going to be a very tax efficient decision that we make. Do we take it at 62? Do we take it at 70? Well, that's going to determine the opportunities that you have during this window of time before you reach RMD age. And so maybe you decide to delay Social Security. Well, if you do that, now you have more window of opportunity to do things like a Roth conversion where you can increase your income and not have to worry about forcing Social Security to become taxable, or not having to worry about, $50,000 of Social Security taking up that room. Instead, you could replace it with a 50,000 Roth conversion while staying in the same type of tax bracket. So those are the types of things that you can start doing if you delay Social Security. Now let's talk about the negatives of that decision, right? Because there's no cookie cutter plan here. There's no perfect decisions. It's going to depend on your situation. So the negative of taking at 70 is, what if you pass away early? Well, if you pass away early, then you may not ever get any Social Security, or you get less paid out. And so that could be an advantage of taking it till 62. So again, you got to weigh the pros and cons there, but we do see some people that they can take it later if they wish to, or maybe they want to prepare for the survivor benefit so that if a spouse passes, they only get to keep one of the two Social Security, so they would keep the higher amount that was waited until 70 to take. So those are just some ideas to think about when it comes to Social Security planning, and just understanding how much is your Social Security going to be, then understanding the tax impact. If you have a moderate income pension or less, then you could potentially have your Social Security less taxable if you plan the right way. There's something called the Social Security tax torpedo, where your income, once it starts increasing in retirement, that's where you start to force Social Security to become 85% taxable as income. If you stay under that amount, your Social Security could be tax-free. And so for a lot of people without pensions, without $1 million, they may never have to pay taxes on their Social Security. If you've got a large pension, you may always have to have that full amount of 85% taxable as income. But if your pension's maybe only $1,000, $2,000, or $3,000 a month, then you may be able to get by with strategic withdrawals from your investments to stay under that torpedo. So again, tax smart, efficient planning is going to be very important for you when it comes to Social Security planning. And the other thing to think about is, how are your investments structured? So we've been talking about Roth conversions, so that's kind of the Roth bucket. So maybe you're still working, you could look at things like a Roth contribution to an IRA, a Roth IRA, or you could do a Roth 401k contribution, or you could look at doing Roth conversions. Now with Roth conversions, there are no limits currently. If you have $1 million in your IRA, you could convert that all if you wanted to. Not everyone does that because that may put you in a high tax bracket, and that may not make sense. And for a lot of our clients, we recommend they have, let's not put all of our eggs in one basket, right? Let's make sure we have more of a balance so that we can choose if taking it out of tax-free or tax-deferred, depending on the situation. And so the Roth could be something that maybe force you to pay more taxes now, but you have to ask yourself, is that going to be advantageous moving forward? For some it will, for some it won't. For most of those in the 2% club, for most of the clients we work with, we are doing Roth conversions for a good amount of the clients we work with. Again, that may not be everything, but maybe small amounts over time to maximize some of the brackets they're in currently, knowing that tax rates will probably be the same or higher as what most people expect, and our clients' income is typically only going to be the same or higher in the future. So we can strategically plan here, but again, more so for the tax diversification. Not all of our eggs in one basket. We want to have the freedom in 10 years or 20 years when we don't know what tax rates will be because it's written in pencil, of which bucket do we take out from? Tax rates are high, let's take from the Roth. Tax rates are low, let's take from tax deferred. So this is going to allow us to more strategically plan and have more control rather than the government having all the control if we have all of our money in tax deferred. If you want $30,000 to take out, we know that's going to be all income, is going to be taxable as income, versus if we have options, we can plan appropriately. And so for a lot of our clients, we run strategic analysis to see, does this make sense or not? Is this going to lead to more tax savings over time? Is this going to lead to more of a net worth over time? And that's what we'd always recommend that you do. Don't just guess or make, just throw a dart and make a decision. You always want to use data when making decisions. That's something we always do for the clients we work with. This is their life savings. We want to make sure they're not missing anything and that they're making the best decisions possible. And do be aware that if you're working with an advisor who hasn't brought up a Roth conversion, or maybe they've never talked about that, then that could be a sign that maybe your advisor does not specialize in Roth conversion. So, you have a few options. One, you could go up to them and say, hey, can we look at this? I mean, you can do that, but if they're not bringing it up to you, then now you're becoming the advisor. What's their specialty if they haven't been seeing it? Where else are they not being proactive? I just don't really get the best feelings when I see advisors take that type of approach. Or if they say, hey, let's just do 50,000 and you ask them, well, why? And they basically guess, well, that's probably a red flag as well. You want to work with an advisor team who's running all those numbers, who's working closely with your CPA. That's one thing that we always recommend is have your CPA and advisor in the same place. Make sure they're working together so you're not missing any of these decisions and you're able to maximize these decisions so that when tax time comes, CPA is not shocked or advisor's not shocked to know that something's off that they weren't communicating on. And so that's something that we always find very valuable. Or to be able to see the last tax return is so valuable when making these types of decisions because maybe the client didn't tell you something that was on their tax return. That's why we love having tax prep in-house is because we're able to see, oh, client, you never told us about that on your tax prep. We'll make sure we plan for that next year because there's so many things going on in someone's life. It can be easy to miss those types of things. Now, when doing these types of Roth conversion strategies, you just want to make sure you're being aware of increasing your income too high in your early years, right? We already talked about the cost of Medicare, forcing Social Security to be taxable. You want to factor all of that into your calculation when you decide to do this or not. And that, I don't say that to scare you from doing it. You may be 63 and you know that you could pay more in Medicare premium. So then the calculation becomes, do I want to go over that first tier and pay more for Medicare for just 1 year to maybe have a lifetime of more Medicare savings? Or maybe that doesn't make sense, right? So those are the types of things that you need to think about when making these decisions. It's all about the long-term impact and how are you going to best have the best results and plans moving forward. Now, something else we haven't really talked about today, if you have a tax problem in retirement, is maybe you consider being charitable, or maybe you are currently charitable. One of the worst things that we see is when people are charitable, not that they're charitable, it's when they give money from their bank account and they don't do strategic tax planning opportunities. That's one of my biggest pet peeves because you're missing opportunities to save money on taxes. You're already doing something good. Let's make it even better. And so, strategies like a donor advised fund or a qualified charitable distribution are ways that you can lower your tax burden if you're giving. And we always tell, people, if you're giving $5,000 or more annually, you really want to start looking at the tax savings that you can get from that charitable giving. That's what we would consider more of a significant gift ongoing. And so if you're giving $10,000, $20,000 a year, then you can look at things like bunching your charitable deductions in 1 year to get over that standard deduction so that you can itemize and maybe do more of a Roth conversion and have less of a tax burden and more tax-free growth moving forward. Or maybe you have a highly appreciated asset that you can move into a donor advised fund, again, get a higher deduction, do more Roth conversions to offset it or other withdrawals from your IRAs, or it can withdraw or offset your pension. And this is going to allow you to be more tax efficient, to save more money on taxes. Again, you're going to need to look at more of these types of opportunities to really save the most possible in your taxes. And these are the type of advantageous things when you're charitable minded at this point. This is going to lead to more savings than someone else who may not be in as high of a tax bracket. So just make sure you understand the power of it as well, not only from an impact, but also just from a tax standpoint for your personal gain as well. And we don't want to just give because of the personal gain. We want it to come from your heart. But another thing to talk about is QCDs. And this is one that we always want people to start preparing for. Again, so maybe you're 60 as we've talked about, but when you're 70 and a half, you can start giving your IRA to a charity. So if you plan to give $10,000 a year when you're 70 and a half and older, well, just understand that when you do your tax planning earlier. So maybe your RMD is expected to be 50,000. Well, we can start planning knowing that our RMD will likely be 40,000 if we're going to give $10,000 to a charity, which is going to allow us to understand how much do we want in Roth or how much do we not, and allow us to better plan for that moving forward. And it also could be a reason, maybe you're looking at that donor advised fund opportunity. Maybe you put enough in the donor advised fund to give out of it until you're 70 and a half, and then you look to use a QCD so you can be strategic in that way as well. So these are all considerations to think about there. But the biggest thing we want to recommend for people is, just make sure you have a plan. Make sure you're working with a team who understands taxes and pensions to make sure you're saving the most possible. And if you are DIYing this, we just hope that you take a deeper dive, or maybe you're getting to the point where you're like, hey, I don't want to follow all the tax rule changes. I don't know all these strategies. We hear often people tell us, I don't know what I don't know. And so if that's you, and if you want just more resources, I'd love to offer our book. If you've listened this long, then you'll be able to request our book called I Hate Taxes. And so this is something I wrote. I personally don't like taxes. I'll pay my fair share, but I don't want to tip Uncle Sam. And so we go through a lot of the more advanced tax strategies here for you to get a better feel of what you need to be looking for and to open your eyes of the opportunities that you have as you reach retirement. So go ahead in the link below. You can request that, put in your address. We'll send that out to you. Our goal with this channel is to be as educational as possible. What can we do to help people make the best decisions moving forward? So with that being said, that's all I've got on today's episode of Joe Knows Retirement.